Hello, this is the Ralph Bivins Project, and I'm Ralph Bivins, and we're here today to talk about change and changing our world, changing our economy, changing our city, changing our real estate markets. And I know that first, okay, if for those of you that don't know, realtynewsreport.com, anybody that's got a computer is welcome to go there and get caught up on the latest news. It's freedom of the press, freedom of everything. There's no paywall. You can come in and check out realtynewsreport.com 24/7. And also we've those of you who are subscribers to another product, we put out the weekly newsletter to this for subscription-based customers and readers. And we recently came out on, well, not that recent, March 1st, exactly on March 1st, we published a column that I wrote that said, hey, March 1st, we hit bottom. That's it. This is just, we hit the bottom. It's not going to be like a skyrocket straight up, but things are going to be improving from here. There could still be some bad stuff happening. Where the soft spots are, where the soft underbelly is. But from here on up, I think March 1 was the bottom. It's going to get better, I think, in a number of places. Some parts of the economy, some sectors, some sub-markets have come through well, but others haven't. But that's it. So that's the prediction. If it's wrong, hey, you forget I ever said it. But if it's right, then remember I said it. March 1, that was the bottom, and we're trending upward from there. And who better to have as a guest today than Patrick Jankowski, regional economist and senior vice president at the Greater Houston Partnership. And he's been there for several decades, and he's made a lot of predictions, and he studies a lot of numbers. He knows a lot about what's going to happen in the city of Houston, which is facing some quite a future. This is the energy capital of the world, and it's been called that for a long time. And everybody knows that, hey, we're transitioning. We're transitioning towards a future with renewable energy, with a future with less reliance on fossil fuels like gas, oil, and there are thousands of people here that work in that industry, and in terms of on blue collar side and filling up office buildings, we're headed for a lot of change. And so we're really grateful that Patrick's taking time to talk with us today. Patrick, how are you?
I'm doing fine, Ralph. It's so good to see an old friend, and thanks for having me on your podcast.
You're one of the best in the business, and we're just really glad to have you here. So I
don't know if I'm one of the best, but I try real hard.
Oh, no.
Like Avis.
That's my opinion. When I've listened to a bunch of them, you do great, and I respect your opinion. And and it's just one thing. We look at the calendar. It's been about a year. I know March and April of 2020, when COVID was really starting to hit this area, the Greater Houston area lost 350,000 jobs, which was the biggest hit we've ever had. I suppose it's pretty phenomenal, quick, hard, fast fall. And we've gained some of that back, but what happens next? What happens next, Patrick? What happens to this economy where we're at?
Let me back up. And you said 350,000 jobs. I want to let the listeners, the viewers, know that if you look at the Great Recession, where we lost about 122,000 jobs, you look at the oil bust of the 80s, we lost about 220,000 jobs. The COVID recession, we lost more jobs in the COVID recession than we lost in the two worst recessions prior. And that was the oil downturn, and that was the Great Recession. So it's unprecedented in this. Mm-hmm. Yes, 350,000 jobs lost. We've recouped about 215,000, leaves us about 135,000 left to recoup.
Hmm.
That's as of December. And what we haven't seen yet are the January employment numbers. We won't get those for another couple days. But with those January employment numbers, we always see job losses in January. Think about what happens in the fall. You see people who are hired by the retail stores, they're temporary jobs. You see people who are brought on by the courier and delivery companies as they're delivering Christmas packages. You see a surge in contract workers who are brought on to help meet those year-end deadlines and goals. If you look at the data over the last 10 years, you always see that Houston in January loses between 40 and 50,000 jobs.
It's supposed to be a happy time, though.
No, it's because of, and you get restructuring plans which were set up in the fall that are finally brought to fruition in January 1st. So yes, although looks like we're short only 135,000 jobs from where we were, you're going to need to add another 40,000 jobs on top of that when we get the January numbers. So really, we've recovered roughly half of what we've lost and have another half left to go. Some sectors have done very well. If you look at finance, if you look at insurance, if you look at professional services, you look at utilities, non-durables manufacturing, things which are easily concerned, they're all above pre-pandemic levels. If you look at oil and gas services, oil field equipment manufacturing, areas like that, those areas have not recovered any jobs or are still losing jobs. Construction falls somewhere in between. What we're going to see is an uneven recovery. And you're going to see some sectors that do very well and some sectors that struggle for years.
Yeah, you don't bounce back from that instantly. And, things like, things that really took a hit, the hotel market, that took a big hit. Your hotels, your retail, things of that nature. Man, it's been horrible, really horrible for people.
Well, think about when you talk about retail, what the COVID pandemic did is it accelerated trends that were already in place. You saw this trend already to shopping online and having delivered at your house. And what it did is it accelerated that. And maybe we were going to talk about this later on, but I went and I did some research, excuse me, as I shuffle through some papers, guys.
Well, everybody knows that, hey, you've seen, like Bed Bath and Beyond and Pier 1, places like that closing stores and going out of business. The shopping centers aren't as full as they used to be.
Let me run off a list of bankruptcies which have occurred in the last 14 months.
Okay.
Ann Taylor, Bell's, Brooks Brothers, Catherine's, GNC, Guitar Center, JCPenney, Joseph A. Banks, Justice, Lane Bryant, Loft, Lord & Taylor, Lucky Brands, Men's Warehouse, Neiman Marcus, Palais Royal, Papyrus, Pier 1, Steinmart, Sur La Table, Tuesday Morning, Francesca's, L'Octane, and Solstice Sunglasses.
That's quite a list.
Quite a list. And so that's going to leave a lot of retail space vacant. The one good thing about that is that retail space, you and I know when we say retail, we're not talking specifically about a retailer. You may see other things go into that space. Eventually, maybe some restaurants, some gyms. You can put a doctor's office. You can put a bank, a dry cleaner, and so forth. I mean, you'll even see churches pop into those. But that's going to take a while to get there for retail real estate. So retail real estate, though, is not in as bad shape as some of the other sectors.
I know. They're and you think, some of these malls you look at are empty, and then recovering from that emptiness, and they're fighting the trend, like you said. It was kind of like, I think you made a good point. We're there, all these things we knew were going to happen. Hey, brick and mortar stores are they have vast competition from Amazon. That's a real thing. And then the pandemic hit, and boom, then it really accelerated, and kind of reminds me of that Warren Buffett thing about when the tide goes out, who's been swimming naked. Your weaknesses get exposed. So it's that happened in retail. And I'm looking at some of these centers you drive around. It's box after box, and not necessarily big box centers that are separate, but a lot of huge spaces vacant, and you wonder some of these malls may just be better off going for a different use. It's just let's do something else with it, and that land may be better for multifamily, or maybe better for some type of manufacturing or something.
Classic example is we can go back a long ways, but think of Westwood Mall. For those people who've been in the market for a while, probably never should have been built. It was too close to Sharpstown Mall, which at the time was a nice mall. And what they did is they totally repurposed it. Great ample parking for the employees. It's a secure facility and so forth. So you will probably see that happen with some of the malls or some of the spaces in the malls. One of the challenges is going to be some of these strip centers. If you start it on Westheimer at the Loop and just start driving west, you'll see some strip centers that have done very well, and you see some strip centers where there's nothing in them. And I think you touched upon it. You're going to see some of these properties where the best use is to have them scraped and then repurpose the dirt.
Mm-hmm. Yeah, I mean, at some point, the value of the building is nothing, and the cost of making it into another purpose, you're better off. Hey, this is a pretty well located piece of land. It's got drive-by traffic, commercial application land. It would be zoned, commercial if we were in another place, but it fits. It kind of fits. So they scrape it. Maybe they put up apartment building. Maybe they put up, housing for sale, condos, whatever. That's tough. But retail's been through it. Retail's been through it.
But retail's not as suffering as. I was going to say retail's not suffering as bad as office is. And I could see retail recovering a lot sooner than office is. We talk about scraping. I live out in the energy corridor, and I've already seen one low-rise office building that was bulldozed, and now there's a sign that the lot's for sale. And I imagine we're going to see a lot of these, especially some of that product that was built in the 70s and early 80s that is obsolete, and you're going to see that happen as well. But the office market has been struggling since 2014, and we overbuilt just like we overbuilt in the 80s. And the challenge is we're not going to have the energy industry grow to absorb that space. The energy industry in Houston, as far as an office consumer, will never be as big as it was even last year. We've seen so much transition in energy. For the energy industry, the high point for that was December 2014. We had over 300,000 people working in upstream energy. And I say that's exploration and production, oil field services, oil field equipment manufacturing, engineering.
300,000.
Now we have fewer than 210,000 working.
200 more. That's a big change. Yeah. What happens to that? Okay, so the energy companies some of them have gone out of business. What happens to their space? They were a big occupier here for so long. Will it just, some of them be torn down, but there's some buildings that are empty right now. Even big office buildings have vacancy problems. What's the hope, man?
I imagine some of those that have vacancy problems are not going to be able to, at some point, not make their notes, and some of them may go into foreclosure. Some of these buildings will be sold you're going to start to see bottom fishers come in already, and some of these buildings will be sold for pennies on the dollar, and then they'll have a lower base, and so that way maybe the rents don't have to be quite as high to cover the note. But the office market, if you look at where we are now, 5 years ago, the availability rate was around 24%. Right now, the availability rate is around 29%. So over the last 6 years, things haven't gotten any better. And if you look at, we had negative absorption last year. Even if you look at the reports just through the first 2 months of this year, we've already had negative absorption this year. And you're not going to see the energy companies absorbing that. And if anything, you'll see more negative absorption because you're going to see more mergers and you're going to see more layoffs. I wish I could say I saw a clear.
Noble Energy, Noble Energy was bought by Chevron. Noble was bought by Chevron, and their office buildings are now not needed. They've laid off, they consolidated their workforce, so those buildings are looking for somebody else to move into them. And there are not that many people wanting. Many companies wanting space. That's the problem.
I wish I could say I saw a clear path out of this for office, but that's the one that I have the least amount of optimism for. That's the one I'm most concerned about.
Yeah, it's when you got this much vacant space. I've heard the number 50 million. I don't know what all that includes, but 50 million square feet of office space vacant is a lot, and it's going to take years to fill that up. And the other part of the issue is these companies are shrinking. In the post-COVID era, they're shrinking their footprints. They're not expanding. We don't want to be. We can take more space, and we're gonna have more people working from home at least part of the week. We may use the space 3 days a week, but we'll have some people working 3 days a week or 2 days a week or 4 days, whatever. The space is that's going to impact the amount of leasing activity. So I think you're right. It is a troubled area, and haven't seen that solution.
Now, Ralph, you brought up that 50 million square feet of vacant space. Kind of put that in perspective for your viewers. Transco Tower has 1.4 million square feet. Excuse me, Transco. Shows you how long I've been studying the market. Williams Tower has 1.4 million square feet.
People know that's Transco anyway. That's I still call it that.
Williams Tower has roughly 1.4 million square feet of space. So you're looking at the equivalent of roughly, let's say, approximately 40 Williams Towers being vacant out there that need to be leased up. I mean, that's kind of sobering.
Yeah, that's more space than many cities have. They more vacant space than many cities have total space. I don't know how we get there. I get one thought that one piece of positive news that has occurred lately is, we've seen, because oil prices going up. We had the big crash in April of last year with oil prices going to record lows, and that has gone up. I think a few days ago it actually hit $70 a barrel, which is a tremendous increase. What does that mean for us and for our energy companies?
Well, one thing, anytime oil prices goes up, it's good for the energy companies and it's good for Houston. When you think back to where it was in March and April and May and all the layoffs which took place, the energy companies were in survival mode. They were desperate. How do we cut costs so we can survive to drill another well? When you get oil up into the 60 where it is now, they don't have to be in survival mode anymore. They don't have to cut employees out of desperation. There'll still be some layoffs, but not to the same extent. The layoffs are things which were baked in last year through restructuring plans. The $70 is a spot price. What you need to understand is that a lot of companies, what they've done is gone out and hedged their production, and they've found someone who will guarantee to take whatever they can produce at a certain price. From the research I've done, a lot of them hedge production around $45 a barrel, like half of whatever they produce they can sell. So they're not going to benefit from that from the full increase in the price. Whatever they sell on the spot market, they'll benefit from. But they've already committed to selling a lot of their production at $45 a barrel. So someone else is going to benefit from that delta. But the important thing is it takes pressure off the energy companies to go follow through with all these layoffs for survival. Mm-hmm. And it also will provide additional cash flow for them. The cash flow will allow them to reinstate some dividends and to pay down some debt and maybe drill a few more wells. So it makes things a lot better, but it doesn't mean there's going to be a hiring surge.
Mm-hmm. So they maybe won't be laying off people at the rapid pace they did in 2020, but they're not going to be hiring back. I mean, I've listened to these crazy people on TV saying, "Well, maybe get back to $100 a barrel again pretty soon." It's just because there's the tightening demand and the fact that people are driving again. People are going to start driving again when the health situation gets better around the country, and so there'll be more demand. I think that Saudi Arabia has indicated it wants to put pressure on the market to make prices go upward. And so those two things, we could get to 100, I suppose. Would that make any difference? $100 a barrel. A year ago, April of last year, everybody remembers that the futures price went below $0 a barrel. So we're trading. You had to pay people $30 a barrel or something to take your oil. So it went negative for the first time ever. Okay, from there we've made vast improvement. It could go to 100. Could $100 a barrel make a difference for the Houston economy?
Oh, sure. You would see a surge in hiring. You'd see a surge. First, you'd see a surge in drilling. The surge in drilling would mean more oil field equipment. More oil field service firms would have more business. You'd see a need for more equipment, so you'd see a pickup in manufacturing. You'd see a need for more pipelines, valves, and flanges. See a pickup there, and you need to have more people supervising operations in the field. So if it went up to $100 a barrel, it would definitely have an impact on the economy. I can't put a number on it, but you would see an increase in hiring. But one of the things that would also come into play was whether they expect those $100 a barrel prices to hold. Right now, OPEC and OPEC Plus, they're holding about 6 million barrels a day of production off the market right now. So if oil prices go up, they're more likely just to they're more likely to see an increase in production in the Middle East. And that would probably be a greater increase in production in the Middle East than we would see an increase in production in the U.S.
Trying to find okay, that's the office is a dark spot, but residential is the bright spot, and we're still record home sales last year, phenomenal amounts. There were things slowed down for a couple of months when the fear level was really high in the spring, but then it picked up. Record level home sales. Interest rates are super low. And I think it's still happening this year. I think the latest numbers, February of 2021 versus February of 2020, we're up a little bit, 1.5% or something, which is amazing considering there's the big freeze in February of this year. So things are still up. What can you tell me about what do you think is going to happen going forward with residential?
Right now, the challenge for residential is not finding buyers, it's finding sellers. If you want to look at the number of listings on the market, this time last year, Houston Association of Realtors had 24,000 single-family homes listed in their database for sale. Right now, they only have 13,000. And so you see that it's putting pressure on prices. If you look at the average price of a home sold that was listed in the Houston Association of Realtors, February last year versus February this year, is up $48,000, is up 16%. It's definitely a seller's market. So if you have some place to live and you can, once you sell your house, this would be a good time to sell. Don't know how long it's going to last, but right now there doesn't seem to be, even though interest rates have ticked up a little bit, they're at about 3 right now. They were at 2.65, their lowest point. The people out there who there's still a lot of people out there who want to buy. And one of the things, it's not just interest rates, but we talked about how this recession and this recovery has been very different. Those who have high-paying jobs, there's a study out there done by Harvard. Those who are making $60,000 or more a year, we've already recouped all those jobs that were lost and then some. Those who are making less than $60,000, those are the ones that are still struggling. And I bring that up because the people who are making $60,000 or more a year are the ones who are in the housing market. Those are home buyers. So you get a husband and wife, both of them make $60,000 a year. That's $120,000 a year of household income. You can qualify for a nice home in Houston for that.
You sure can.
So, but you can look at it though for the brand new homes. There's a concern out there that there are not going to be enough lots, that we're running out of lots because we just can't develop them fast enough and people are buying so fast. So that's probably the biggest limitation on what's going to happen with housing is whether we will have enough lots to build on in 2021. Yeah,
it's building big. And I've also read that there's a real shortage of lumber, and that's or at least the price has really gone up a lot. So they need lots, land, labor, lumber, the 3 L's. But yeah, if I think that could keep going, and if there's been a lot of movement to the burbs, and outer suburbia is getting more and more activity during this over the last year. But yeah, why can't we develop them fast enough? The big thing you just struck me when you were talking is, affordability. That's housing affordability when you've got prices going up at that rate. It gets to be a concern.
Well, that's one thing that the developers in Houston have done a really good job of being able to bring a product to market that's affordable. The sweet spot for housing in Houston is a house price between $200,000 and $400,000. Hmm. And one of the things you've seen them do is they're putting them on smaller lots, and that helps. The other is maybe readjusting the finishes and so forth. Right. The issue for home sales in Houston, as far as new homes, it is not economics. It is really supply of land, lumber, even appliances, cabinetry, hardware, windows, because it's not just in Houston. We're seeing building surge across the U.S. So I wish I'd bought lumber futures a year ago.
Yeah, that would have been a good thing. Well, I can't let you go before, I guess everybody knows that Patrick does a very accurate annual forecast about how many jobs are going to be created in the Houston area. And he usually releases that around the first of the year. And he's done that for quite some time. And over time, you look at who's nailed it, and he's come pretty darn close on many occasions. So, Patrick, 2021, give us, you've had a couple of months now to see what's happened. And then for 2021, what do you see happening with our regional economy here in the Houston area?
I'll let you know the forecast that I issued on December 1st. Mm-hmm. I need to let you know I am in the process of revising that.
Okay, well, here's a great place right now, right here. Let's do it.
Well, I'll let you know that forecast is probably on the low end. I thought that we would max out at around 55,000 jobs. I think maybe now 55,000 may be on the low end. I think we're going to do better than 55.
Better than 55,000.
We're not going to do 100,000 like some people out there are saying. There are very few times in Houston's history we've ever done 100,000. But I think we're going to get back to somewhere above 50, easily 60. Whether we get above that, it depends upon how high above that. I haven't finished with the numbers yet, but I think easily we're going to do 60,000 jobs this year. We may get as high as 80, maybe even higher than that, but I don't think we're going to hit 100,000.
Why is it going to go up, and why the revision? What's happened since we finished?
Well, a couple things is the forecast that I issued back in December was based on the data that was available in October and November. And back then, the coronavirus is driving everything. And we were looking at the economy still being shut down in the first quarter of this year. We were looking at cases spiking in March. As it is, the cases spiked 2 months earlier. They spiked the first week of January. So that has moved it up. Also, we've come up with an awful lot of stimulus that was hopefully will be passed by the time this podcast is released. And that has actually juiced the recovery as well. Mm-hmm. So we are going to hit a tipping point. And the tipping point will occur once we hit that magic herd immunity. And so what we're hoping for is that once we hit that tipping point, you'll see all this demand unleashed and you'll see things pick up. One of the reasons why I won't go up to 100,000 though is because the years we've hit 100,000 is the years when the energy industry has boomed. And the energy industry is not going to boom this year. It's going to weigh us down. If we had a booming energy industry, I could say 100,000, but we're not. We're going to get back to normal growth. And we still have some things that are going to be weighing against us. Construction is very soft right now because of overbuilding in so many places. The restaurants, there's this talk about people wanting to go back to the restaurants. Well, right now, Houston lost anywhere between 1,000 and 2,000 restaurants during the pandemic. So those restaurants aren't there for people to go to or for them to hire people back. We talked about the retail bankruptcies. So those are going to be mitigating factors which are going to prevent us from getting up to that 100,000. But if you can see growth in the other areas, I can easily see us hitting 60,000 this year.
60 or even more.
Or even more. There's an old joke with economists that you should forecast a number or you can forecast a date, but you never forecast the two in the same sentence. So I feel comfortable with the 60,000. The question though is when we hit that tipping point. I think the tipping point will be sometime mid-year, which means we'd be adding a significant number of jobs in the second half of the year.
Yeah, well, that's good. Hey, well, maybe I'll be right on my March 1 was the bottom of the market thing prediction.
I agree with you on that. I think we have hit the bottom. I think we are turning up. If nothing else, you can just look at people's attitudes. They see light at the end of the tunnel. This time last year, we had no idea how long this was going to last. And in the fall, we were expecting to see a spike in deaths. In the spring, we were expecting things to get so much worse in Q1. But that hasn't been the case. We think things getting better in Q1. So yeah, we're off the bottom. We're at the turning point as far as improvement. But where they get the tipping point for that unleashing that pent up demand will be sometime this summer.
More vaccines are coming. Johnson & Johnson, they're sticking people with Johnson & Johnson vaccine today. And so there's the progress of, I think they've got their systems down, that for arranging people and organizing them and getting to a place where they can get the injections. That's more, of course, it's getting better and better organized every day, and more companies being involved. That's a hopeful sign, and I think everybody is happy about that, and we're thankful for that. So we're really ready to turn the page and put that in the history books. And I am. It's been so tough and so many sad stories and so many people losing their jobs, and it's things are going to be better tomorrow than they were yesterday. So I'm grateful for that. Patrick, thanks for your updated forecast. That's very interesting. We'll be waiting to see after you sharpen your pencil where we're going to come out there, but it's I think that's big news that you've raised your expectations.
Oh yeah. I will come out with a formal number within a month or two.
Okay.
I'm hoping, but I need to see just a little bit more data. Forecasts are based. You have a baseline, and you forecast off that baseline. I need to see what the new baseline is going to be that I will forecast off of once we have a few more vaccines and a little bit more job growth.
Great. Well, Patrick Jankowski, Greater Houston Partnership, we appreciate you sharing your insights with us and taking time to talk today. And we'll be looking for that new forecast.
Yeah, Ralph, this is fun. I enjoyed this. I hope you have me back again.
Well, I sure would like that. We'll make a point of it. Okay.
Okay.
All right. Thank you, Patrick.
Sure. Bye. Good luck, everybody.